And now we have Lance Roberts here, Chief Investment Strategist at RIA Advisors. Now, thanks for joining me, Lance. I'm sure you're following the Credit Suisse story. Let me just get your quick reactions there. What are your thoughts?
Well, look, what's happening with Credit Suisse, of course, one of their biggest investor is basically pulled out, so to speak. But Credit Suisse has had problems for quite some time. This is not a new thing for Credit Suisse. They've had trouble with different derivatives, et cetera. So, this is one of those banks that has been in trouble previously and has been kind of struggling along over the last several months, really. And this is just kind of the culmination of really a period of trouble for the bank. But, unfortunately, this comes on, right here at the same time that we're talking about Silicon Valley Bank and Republic National Bank, et cetera. And it's just all kind of falling into this umbrella of financial stress.
Right. This comes after SVB, right? And in your show, you're calling it the bailout week. Now, my question to you is, are taxpayers bailing out the banks? I know there's different programs, this program, that program, but once upon a time, where did the money come from in these programs?
Well, that's right. So the way this support for the banks right now is being put together is that it's the FDIC and the Federal Reserve and the Treasury coming together and putting together this guarantee of investor deposits. And they're saying this isn't a taxpayer bailout. But, ultimately, at the end of the day, that's where all the money comes from. Whether the FDIC has it, they collect that from fees at banks. SIPC, which is the insurance behind brokerage accounts, that comes from fees from consumers and traders that are investing in markets. So all these things, ultimately, all the money that is ultimately used to support or to guarantee depositors or to support banks, it all comes from taxpayers, either initially or at some later date. It's just a function of where the dollars are made.
So officially, this is not a bailout, if you will. It's a backstop, apparently. So in your view, is there an argument to be made that this is one way or another maybe a form of QE?
Well, it's not. Well, so, what quantitative easing is basically an asset swap between banks and the Federal Reserve. So this is not technically QE. This is a backstop. The real question is this another form, or is this the beginning of a bailout for banks? And, it's too soon to tell. This is very reminiscent for me of what we saw in 2007 when Bear Stearns got into trouble. They had two big funds that were running basically subprime mortgage mutual funds. They got into trouble. The bank got into trouble. Then the government kind of facilitated the sale of Bear Stearns for $2 a share at that time. And that was kind of a quote unquote backstop, for the financial markets. Now, immediately after that, markets rallied all-time highs, but that was that first initial crack in what we call financial stability. And we've been warning for a year now that this most aggressive rate hiking campaign by the Fed will eventually break something. And this is really that first crack. Now, the real question is there more to come? And if there is more to come, then this is going to require the Fed to start cutting rates, going back to QE. That will be the eventual end result.
Let me get you to weigh in. Do you feel like there should be a bailout here for Silicon Valley Bank?
No. Look, we have capital. Capitalism is come under attack a lot over the last couple of years. And, we blame capitalism for wealth inequality, et cetera. And that's not really capitalism. That's corporatism that's causing that problem. And part of corporatism comes from the fact that we don't allow capitalism to function. And when capitalism is allowed to function, that means there's winners and there's losers. And that means that sometimes we have to allow banks to fail. And again, Silicon Valley Bank is getting bailed out. Most of are getting supported, but most of those depositors are very rich corporations, very rich individuals that have money there. And, that's a risk. When you deposit more money into a bank than what you are covered by FDIC insurance, that is a risk that is on you as an investor or as a depositor. You should know better, and you should diversify your deposits accordingly. And so, no, every time we go in to bail out or to support or to guarantee deposits, yes, there is a very negative context to not doing that. Yes, it is going to impede economic growth. Yes, it is going to cause pain in the economy. But if you ever want to get the economy back to where it is functioning properly without needing bailouts every time we have a crisis in the economy, you've got to allow capitalism to work. And I know that's a harsh statement. People disagree with that. But it's just a function of how capitalism has to work in order to be healthy and to benefit the economy as a whole.
Right, right. I agree. Now, this is a side question. Let's say we get another bank collapse. Do we have enough money to bail out another one?
Well, yeah, we can always print money. That's the, it's not necessarily a good thing, but yes, we can bail out banks, as long as it takes. But every time we do that, it requires more debt. And the more debt that we continue to pile on into the economy, already over 31 trillion now, you go to 35 trillion to bail out the next set of banks, or 40 trillion to bail out the banks after that. That's more debt on the economy. That detracts income and revenue from production into servicing debt, and that slows economic growth over time. And so the reason that we have wealth inequality, the reason that we have slower economic growth, is because we are dependent upon low rates in order to support the debt that we are using to fuel economic growth. And that drags everything to the lowest common denominator in terms of the economy. You cannot create economic growth from debt because debt requires service. So at some point, again, we've got to go back to this, the understanding that if you want stronger economic growth, if you want better wealth equality, you've got to allow the economy to function like it's supposed to.
Right, right. And let's talk a little bit about the Fed. We have a meeting coming up. And on your show, you talked a lot about that as well. You're saying the Fed is between a rock and a hard place. And maybe just tell our viewers a little bit about that.
Sure. Well, look, the Fed's got a very tough choice. They've been, over the last year, combating this inflation monster that we have going on in the economy, which was a direct result, by the way, of $5 trillion worth of debt, sending checks to households, giving people money to spend, shutting down the economy. You have a supply-demand imbalance, right? Everybody had money to spend, no supplies, prices went up. That's why we have inflation. So now the Fed has been fighting that by hiking interest rates over the last year. So now the challenge for the Fed is this. We still have high inflation. The latest CPI report just came out, still running 6% inflation. That's 4 percentage points above the Fed's target of 2%. So if they stop hiking rates now and turn to start bailing out banks or to lower interest rates to help support economic growth, whatever it is, well, that's going to allow inflation to start rising again, which is what they don't want to do. But if they keep hiking rates, what just happened with Silicon Valley Bank and Credit Suisse and others is likely to continue, because the higher interest rates go, the more it impacts all this debt that we have in the economy. So the choice for the Fed is the rock and the hard place. The rock is to fight inflation. The hard place is bailing out the economy. You've got to choose one, and there's no situation where you can do both at the same time. So it's going to be very interesting to see what the Fed does at this meeting next week.
Right, right. The Fed can't do both, but we can guess on which one the Fed cares more about, right? The banking sector or inflation. What do you think?
Oh, no. At the end of the day, banks always come first, right? Because remember, the Federal Reserve, the members of the Federal Reserve are the big banks, and they receive a dividend from the Federal Reserve. So, yes, at the end of the day, the Federal Reserve will support the banks, as they always have. And the question is just, do they do it sooner rather than later? Now, importantly, there's a big difference. The banks that are members of the Federal Reserve, those are your big major Wall Street banks, as JP Morgan and others. They have a whole side of their business. It's investment banking, Wall Street, money trading, asset management, which generates massive fees. That's why JP Morgan is not a problem in our financial system right now. It's the regional banks that are not members of the Federal Reserve and only have traditional banking. They don't have an investment banking platform. So the real risk in the financial system is these regional banks around the country, these smaller banks. That's where the risk is in the financial system. But ultimately, at the end of the day, that impacts the entire system. And so at some point, the Fed will give up its fight on inflation, regardless of where it is, to go fix the financial system.
So if we're speculating about how many basis points we're going to see next meeting, if we take into consideration that the Fed cares about the banking sector much more than inflation, if it doesn't hike at all, should we be concerned? Is that a signal for something that's very serious that's happening in the banking sector?
Yeah, what I think we'll see is the Fed hike 25 basis points And I think we'll see them soften their language in terms of their inflation fight. I think they'll definitely make a mention of financial stability, and they'll make notice of what happened with the banking system. They'll say that they're watching this very closely. They're monitoring incoming data, et cetera. But I still think they'll hike 25 basis points, because if they didn't, if they come in at no rate hike and mention financial instability, the immediate response from the market is going to be, there's more trouble here than we realize. And that could really cause a much larger sell-off in the market, as opposed to what everybody's thinking. Everybody's been hoping that, the Fed's going to pause or pivot, and that means that's great for stocks. Never in history has the Fed paused rate hikes or pivoted rate hikes where that was good for stocks, because when the Fed pauses or pivots after a rate hiking campaign, that's because they've broken something either economically or financially. So if the Fed would pause or even cut rates, which is, I don't think it's going to happen, but if they did, that signal tells you that there's a lot more wrong with the system than what we currently realize.
So if the Fed keeps hiking, what are the risks that we should be looking out for regional banks going forward?
Well, again, the risk that you're looking for really is ultimately credit. And it's not just necessarily regional banks, and they're just the ones that are right now, they're kind of in the focus. But remember, 20% of the Russell 2000, these are these small cap, these smaller cap corporations that are in that index. About 20% of those rely on debt in order to meet funding requirements, et cetera, for the companies. There's what we call zombies, because they rely on debt to stay alive. And with higher interest rates, that makes it much harder for them to refinance their debt. And there's a big debt wall that's coming up this year, next year, that has to be rolled over and refinanced, and that's not to be done at higher rates. So the things you're looking for are not just necessarily in the banking system, but also looking at consumer credit delinquencies and defaults, as well as corporate defaults and corporate bankruptcies. So all of those will tell you, those are all good leading indicators that the economy is starting to break down at some level.
I see. All right. Well, thank you very much, Lance, today for your valuable insight. It was a pleasure speaking to you, as always.
Thank you very much. I appreciate it.